Welcome to AS Bullion. This is the complete guide to liquidity in gold trading. We are going to take you from first principles all the way through to advanced smart money concepts, framed entirely for XAU/USD. Liquidity is the single most important concept in modern trading, and once you understand it, you will never look at a gold chart the same way again. Let's get started. Part 1. Foundations. What liquidity actually is. Liquidity is simply the ease with which an asset can be bought or sold without moving its price. A market is liquid when there are many willing buyers and sellers at, or very close to, the current price, so a large order can be filled quickly at a fair price. It is illiquid when orders are sparse, spreads are wide, and even a modest order pushes the price sharply. For a trader, liquidity has two meanings, and confusing them is the #1 beginner error. The first meaning is market liquidity, the classic definition. How deep and tradable the market is, based on volume, spread, and order book depth. The second meaning is liquidity as orders resting at a price. These are clusters of stop losses and pending orders that sit above highs and below lows, waiting to be filled. This is the liquidity in liquidity pool and liquidity grab. Here is the key idea. Every stop loss is, to someone else, a market order waiting to happen. A buy stop above a high becomes a market buy when hit. A sell stop below a low becomes a market sell. Large players need those opposing orders to fill their size, so price is repeatedly drawn to where stops, or liquidity, are stacked. Why liquidity matters and why gold is special. Gold is one of the most liquid instruments on Earth, but that liquidity is fragmented across venues and concentrated in time. Spot XAU/USD is the over-the-counter market quoted by banks and brokers. It is deep, trades 23 hours a day, 5 days a week, with tight spreads during active hours. COMEX futures set much of gold's price discovery. Its volume and open interest are a core liquidity and positioning signal. Gold ETFs like GLD represent slower, structural flows, and central banks, particularly the PBOC, buy physical gold in size on dips, creating a durable demand floor rather than intraday pools. The 3 sessions when gold liquidity lives. Gold liquidity is not constant through the day. It follows the sun across the major financial centers. The Asian session, roughly midnight to 8 a.m. GMT, has lower liquidity and tighter ranges. It often builds the Asian range that London later sweeps. The London session, 8 a.m. to 4 p.m. GMT, is where liquidity surges. The London Open often produces a sharp move that raids the Asian range highs or lows before the real trend appears. This is called the Judas swing. The New York session, 1 p.m. to 9 p.m. GMT, delivers the highest volume, especially during the London-New York overlap from 1 to 4 p.m. U.S. data at 8:30 a.m. Eastern and COMEX pit hours drive the biggest liquidity events. Why sessions matter for pools. Each session leaves footprints, a session high and a session low. Each becomes a liquidity pool for the next session to target. The classic gold rhythm is this. Asia builds a range. London sweeps one side of it to grab liquidity. Then New York delivers the day's true directional move. Trade the reaction to the sweep, not the sweep itself. This session-to-session flow is the foundation of everything we will cover next. Part 2. Liquidity pools. Buy-side versus sell-side liquidity. Every pool is either buy-side or sell-side, defined by the type of order resting there. This is the single most important classification in the whole subject. Buy-side liquidity rests above price, above swing highs, above equal highs, above the session or day high. It is made of buy stops from short stop losses and breakout buyers. When price rises into it, those orders fire as market buys, fueling a spike up that is often the end of a move up. Sell-side liquidity rests below price, below swing lows, equal lows, the session or day low. It is made of sell stops from long stops and breakdown sellers. The counterintuitive truth about liquidity. Price often rallies specifically to reach buy-side liquidity above and then reverses down. And it drops to reach sell-side liquidity below, then reverses up. The liquidity grab is frequently the exhaustion point, not a breakout. Buy-side taken means look for shorts. Sell-side taken means look for longs. One structure confirms. This is the opposite of what most retail traders do, and it is why they get trapped on the wrong side of the move. Where pools form in gold, the map. Structural pools include previous day high and previous day low, the most watched intraday pools. Previous week high and previous week low for swing traders. Session highs and lows from the Asian range, London, and New York. And old, untouched swing points on the daily and 4-hour charts. Equal highs and equal lows are the neon sign of engineered liquidity. When price prints 2 or more highs or lows at almost the same level, retail sees a double top or double bottom and piles stops just beyond. That is exactly why these are prime liquidity targets. Round numbers are gold's favorite pools. The whole thousand, like $4,000, the half marks, and the century marks are the densest pools on the board. Part 3. How price hunts liquidity. Stop runs, sweeps, and raids all describe the same event at different scales. Price pushes just beyond a pool, triggers the resting orders, and then rejects. The wick beyond the level is the signature. A liquidity sweep is a quick spike through a high or low that takes the stops and immediately reverses, leaving a long wick and usually closing back inside the range. How do you tell a sweep from a breakout? A sweep has a sharp spike, a long wick, fast rejection, and a close back inside the prior range. A breakout shows price accepting beyond the level, consolidating, and closing beyond it. Rule of thumb: rejection means sweep, fade it. Acceptance means breakout, go with it. Wait for the candle close. Inducement, the bait before the pool. Inducement is a small, obvious pool of liquidity placed before the real target, used to lure breakout traders in so their stops become fuel. A minor swing high just under a major old high is classic inducement. Breakout longs enter on the minor high. Price then runs their stops on the way to the major pool and reverses. Learning to spot inducement stops you from being the liquidity. The Judas swing is the session deception. Named for the betrayal, it is an early session move in the wrong direction designed to grab liquidity before the true move. In gold, it typically appears at the London or New York Open. Price fakes one way, sweeping the Asian high or low, trapping traders, then reverses into the genuine daily direction. Draw on liquidity. At any moment, ask, what is the nearest untapped pool and on which side? That pool is the draw on liquidity. The magnet price is most likely reaching for next. Your directional bias should point toward the most obvious, unmitigated liquidity, not away from it. Gold trends session to session by moving from one pool to the next. Once you internalize this, you stop asking where price is going and start seeing why it is going there. Part 4. Smart money concepts. Market structure, break of structure, and change of character. A break of structure, or BOS, is when price breaks a prior swing point in the direction of the trend. It is continuation. A higher high in an uptrend, a lower low in a downtrend. A change of character, or CHoCH, is the first break against the trend. It is the earliest sign the trend may be turning. After a sell-side sweep, a bullish CHoCH is your reversal trigger. Liquidity plus structure is the core combo. A sweep takes the stops, then a CHoCH confirms the reversal, then you enter on a retracement. Sweep without structure means do not trade yet. Order blocks. An order block is the last opposing candle before a strong, structure-breaking move. It is the footprint of institutional orders. A bullish order block is the last down candle before a sharp rally. A bearish order block is the last up candle before a sharp drop. Price often returns to mitigate the order block, offering a high probability entry in the trend's direction. The best order blocks are the ones that caused a liquidity sweep and break of structure. Fair value gaps, or imbalances, are a 3-candle pattern where price moves so fast, it leaves a gap. The middle candle's range is not overlapped by the wicks of the candles either side. It marks an imbalance where buyers or sellers dominated with no counterparties. Price tends to return to rebalance the gap, making it both a magnet and an entry zone. Premium and discount zones. Draw a Fibonacci from a swing low to swing high. Above the 50% midpoint is premium territory, expensive, favor selling. Below 50% is discount territory, cheap, favor buying. The optimal trade entry zone sits around the 0.62 to 0.79 retracement. Combine it with liquidity. Buy in discount after a sell-side sweep. Sell in premium after a buy-side sweep. This ties the liquidity pools to a precise engagement zone. Internal versus external liquidity. External liquidity is the obvious swing highs and lows that bound a range, the big pools. Internal liquidity is the fair value gaps and minor pools inside the range. Price typically oscillates between them. Take internal liquidity, reach for external liquidity, sweep it, reverse. Part 5. Institutional and Order Flow View. The Order Book and Depth of Market. On COMEX Gold, you can watch the depth of market, the live ladder of resting bids and offers. Thick resting size can act as a wall, short-term support, or resistance. Thin books mean fast, spiky moves. Beware of spoofing, large orders posted to mislead then pulled, and iceberg orders, big orders hidden behind small visible size. The depth of market shows resting intent. The tape shows what actually traded. Read both. The CHoCH report from the CFTC gives a weekly breakdown of futures positioning. Extreme managed money longs mean a crowded trade vulnerable to a long liquidation flush. Options liquidity and the structural bid. Gold options create their own gravity. Max pain is the strike where the most option value expires worthless. Price is often drawn toward heavy strikes into expiry. Large round number strikes like $4,000 concentrate open interest, reinforcing those levels as liquidity magnets. Dealer gamma hedging can pin price near big strikes during low volatility or accelerate it once breached during high volatility. And then there is the structural bid unique to gold. Official sector buying, the POX multi-month buying streak and others via the World Gold Council, is price-insensitive, dip buying demand. It does not create intraday pools, but it builds the durable floor that keeps deep sweeps into big levels getting absorbed rather than collapsing. Part 6. The Gold Liquidity Playbook. The core setup is sweep, change of character, fair value gap entry. This is the single most reliable liquidity model. Step 1. Map your pools. Mark previous day high and low, the Asian range, equal highs and lows, and the nearest round number. Step 2. Wait for a sweep. Price spikes beyond a pool and rejects, leaving a long wick and closing back inside. Step 3. Confirm with a change of character on the lower time frame, such as the 5-minute or 15-minute, against the sweep direction. Step 4. Enter on the pullback into the resulting fair value gap or order block. Step 5. Place your stop just beyond the sweep wick where you were proven wrong. Step 6. Target the opposite pool or the draw on liquidity, scale out, and trail behind structure. Session models for gold. The Asian range sweep. Mark the Asian high and low. At London Open, fade the sweep of one side back into the range. This is the classic Judas swing reversal. The London rate. London grabs previous day low or previous day high. Trade the reversal toward the opposite pool as New York confirms. The New York 8:30 data void. US data creates a liquidity void or spike. Wait for the hourly close, then trade the retrace into the fair value gap rather than the first spike. The round number fade. At a big figure like $4,000, fade the sweep. Spike below, reclaim, go long. Spike above, reject, go short. Only with confirmation. A worked example using gold. Applying the framework to a live board where XAU/USD sits around $4,010. Sell-side liquidity pools rest below 4,000 and under the 3,975 area. Buy-side liquidity rests above 4,060 and the 4,087 to 4,100 zone. A textbook long setup. Price sweeps 3,975 or 4,000. Grabbing sell side. Prints a bullish change of character on the 15-minute, and you enter the pullback into the fair value gap with a stop below the sweep wick, targeting the buy side at 4,060, then 4,087. A textbook short. Price rallies to sweep 4,060 or 4,087, grabbing buy side into the descending trend line, rejects, and you short the retrace toward 4,000, then the sell side below. Part 7. Risk, mistakes, and reference. Trading around liquidity events. Spreads widen and slippage spikes during sweeps and during the 8:30 a.m. Eastern data releases. Size down or stand aside during these windows. Put stops beyond the pool, Never exactly on the obvious high or low the market is hunting. Never enter on the sweep spike itself. Wait for the change of character or candle close confirmation. Gold gaps over the weekend on geopolitics, so reduce exposure into Friday close. Risk only 0.5 to 1% per trade. Gold's average true range is large, so size your lots based on stop distance, not a fixed lot size. One clean setup beats 5 forced ones. Most bars are not liquidity events. The top 8 beginner mistakes. Treating a liquidity sweep as a breakout and chasing it, then getting reversed on. Placing stops right under the obvious low or above the obvious high. Trading the first move of London or New York, the Judas swing, as if it were the real trend. Ignoring the higher timeframe draw on liquidity and fading with the wrong bias. Confusing internal fair value gaps with external swing liquidity and targeting the wrong one. Forgetting gold's structural bid and shorting deep into the demand floor blindly. Entering before a change of character confirms the reversal. And over-leveraging into the 8:30 a.m. data window when spreads blow out. Quick reference glossary. Liquidity means ease of trading without moving price or resting stop orders at a level. Buy-side liquidity and sell-side liquidity are above and below price respectively. A sweep or grab is a spike through a pool that takes stops then rejects. Inducement is a bait pool placed before the real target to trap traders. The Judas swing is an early session fake move that grabs liquidity before the true move. Break of structure is trend continuation. Change of character is the first break against trend, a reversal signal. An order block is the last opposing candle before a strong structural move. A fair value gap is a 3-candle gap price, tends to return and fill. Draw on liquidity is the nearest untapped pool price is likely reaching for. Premium and discount are above and below the 50% Fibonacci. Max pain is the option strike where most contracts expire worthless. The liquidity checklist. Print this out and keep it at your desk. Have you marked previous day high and low, previous week high and low, session highs and lows, equal highs and lows, and round numbers? Have you identified the higher timeframe draw on liquidity, the nearest untapped pool? Have you waited for a sweep with a wick and rejection, not a breakout chase? Have you confirmed a change of character against the sweep before entering? Is your entry into a fair value gap or order block with a stop beyond the sweep wick, targeting the opposite pool? And have you respected the structural floor and sized for gold's volatility? That is the complete guide to liquidity in gold trading, from first principles to the institutional playbook. Liquidity is not a theory. It is the plumbing that moves price every single session. Learn where the pools are, wait for the sweep, confirm with structure, and trade with the market's intent, not against it. If this was helpful, like, subscribe, and turn on alerts so you never miss an update from AS Bullion. Trade safely, and we will see you in the next one.